everyone, and welcome to our discussion today about corporate goodwill, goodwill impairments, and financial analysis techniques that financial analysts can use to assess the value of goodwill assets on the corporate balance sheet wisely. I'm your host, Matt Kelly, and we're joined by two experts today who have spent a lot of time thinking about goodwill on the balance sheet. First is PJ Patel, co-CEO and managing director at Valuation Research Corporation. That's an advisory firm that has specialized in valuation services for years.
Hi, Matt.
Also joining us is Pranav Ghai. He is CEO of Calcbench, which is a financial data platform that tracks all sorts of corporate financial disclosures, including goodwill.
Hi, guys. Glad to be here today. Thank you.
All right, guys, before we dive into a discussion, let me just pull up some facts for the listeners here. First, companies spend more than $2 trillion on mergers and acquisitions every year, and goodwill, which we will define as the value the buyer places on a target that is above the target's book value. Goodwill accounts for a significant portion of those deals. Among the S&P 500 collectively, they have more than $3 trillion in goodwill listed on their balance sheets right now. And average goodwill per filer has increased by 35% since 2014. At the same time, it is well known that most M&A deals don't actually achieve all of the synergies that people like to hope for at the beginning. And by several academic studies, more than 70% of M&A deals fall into that category of coming up a little short. So clearly there's a lot of M&A activity, a lot of goodwill that does need to be evaluated, because if you don't, or the deal gets that valuation wrong, that can lead to significant write-downs and impairments sometime down the road. Nobody likes that. So my first question would be, just let's start with how much corporate goodwill is on the balance sheets today. How much in total? How much is a portion of total assets by industry? Anything like that. PJ, what can you tell us?
Yeah, Matt. So we see a lot of goodwill in the deals that we work on. And a big part of this just reflects the environment, the economy. The companies today are more focused on software, technology, intellectual property, brands, and things of that sort. And those are components of the goodwill that you talked about earlier. So earlier you said, it's the excess value over book value, but it also includes brands, technology, customers, and things of that sort. So I think, like, for instance, when we work on technology deals, you might see 100% of the purchase price actually being allocated to intangible assets and goodwill. And that's the environment we live in. That's, so I think that's a factor. Another factor is just how things have changed over time. And there's a large, well-known company that we recently worked with, and in the 80s, their margins were, say, 10%. Mm-hmm. Today, their margins are in the low 20s. Their working capital levels as a percentage of revenue haven't changed. In fact, they probably, if anything, declined. Same thing with their fixed assets. They haven't increased. They've probably declined or maybe stayed the same as a percentage of revenue. So now you've got a lot of excess profit that's related to intangibles and goodwill. Yeah. So it's really a reflection of the environment that we're in. There's just much more value in intangible assets, intellectual property, and goodwill.
And Pranav, can you give us some historical context here, some stats about the trends of where goodwill is going?
Sure. We've seen average goodwill per firm. If you look at the U.S. filing universe, and then you take out, for this analysis purpose, we'll take out all financial firms from it, because financial firms tend to be very big. They do acquire, but their balance sheets are so big that the acquisitive nature isn't necessarily a hindrance to them. But if you strip out financials, you'll see that the average goodwill for firms that report at least 100 million in goodwill has gone from about 1.9 billion per firm to, at the end of 2018, over $3 billion, almost $3.4 billion per firm. So it's a non-trivial amount of money that we're talking about that's sitting there.
Yeah. And I know that PJ had talked about tech sectors being very heavy in goodwill, and financial services is a special case we put aside, but do we have any other indicators about various industries, like which ones are goodwill heavy?
Well, there are firms in telecom that are actually quite goodwill heavy.
Yeah.
Some of the big telecommunications firms, the three biggest, they have tremendous amounts of goodwill on the balance sheet.
PJ, where do these goodwill numbers come from? You talked a little bit about some of the criteria that go into it, but tell us a little more about how you look at those kind of things and then come up with what's the number.
Yeah, it's a combination of things, really, Matt. I mean, we're starting with the purchase price in a transaction, M&A transaction. As you pointed out earlier, we're subtracting the value of working capital and PP&E. Yeah. And then you're left with this chunk that's related to the intangibles and goodwill. Now, similar to the fixed assets, we're valuing the intangible assets, the trademarks, the brands, the technology, customer relationships. And that excess, after you take into account those items, is goodwill. Mm-hmm. So it's a combination of things. One is, specifically identifying components of what you're calling goodwill, but then it's also the excess.
How much is this art versus science?
Well, I think today it's much more science than it was in the past. So in the past, I think a lot of times how do you value intangible assets was maybe more difficult. But today we've really got a bunch of tools that we can use to put a value on trademarks, technology, and other intangible assets. So it's there's still some art to it, but today, quite frankly, it's much more science than it is art. Now, having said that, right, when you're talking about intangibles, when you're talking about goodwill, you're talking about the future, yeah. Right? When you're thinking about more tangible assets, whether it's working capital or PP&E, that's kind of like, what's the value today? And you can look to the market to come. When you're talking about intangibles and goodwill, it's really about the future outlook for the company, mm-hmm. the future benefits, the margins, things of that sort. So it's inherently going to be a little bit more subjective. Yeah. But again, we've got some good tools that we can use to put a value on things, and the science is definitely there today.
So Pranav, tell us a little more about where you would actually find that goodwill, not just on the balance sheet for all of the goodwill, but specifically in a deal where the purchase price gets allocated across a couple of different items. Like, how does that work? Where would one find that? What can you tell us?
Sure. So we today, as PJ well knows, all of these acquisitions are you get a headline number reported in the press and in a press release. Once all of that sort of dies down at the end of the quarter or the end of the calendar or fiscal year, the company has to disclose the valuation that they gave the acquisition and break it down into its component parts. And you would find that in the business combinations footnote detail of the 10K or 10Q. Mm-hmm. And we, in our business, what we do is we collect all that information and report it back to our clients in a usable way. And so that's part of why it's become much more science-y over the years, because a decade ago, which is for guys like us not that long, you would have to cull a lot of this material by hand. You'd have to have maybe an offshore team or something and they still do this, input this information directly into a database and all of that. Today, all of that information at the end of the quarter or at the end of the year is now machine readable, and you're able to import it just directly, apply some potential algorithmic cleaning techniques to it, and hand it out to people to use in their own way. And they can now, instead of doing 15 or 20 companies sort of intensively, they now have literally every single acquisition that took place, if it was material, over the last 5-8 years.
Mm-hmm. It's much easier to surface that data.
I was going to say it's really helpful just in terms of helping you understand an industry and the types of assets that are present, the level of goodwill that's present, and just sort of what are companies composed of as they're doing deals. Mm-hmm. we find it to be a really useful analytical tool.
Let's talk about impairment to goodwill next. Pranav, could you give us any numbers about how much impairment happens or what's out there, what the trends are, anything like that?
Yeah. So we have some data. In 2018, the amount of goodwill that was impaired is about $64 billion. Mm-hmm. And there was one charge in particular, the GE charge, that was $22 billion of that total, followed by Kraft Heinz, with their major announcement, and $7 billion. The prior year, 2017, had about $22 billion. So 2018 was a relatively large year for that, for an impairment loss in that perspective. But we can go back further through time very quickly and look.
Pranav, I think one of the interesting things with those numbers is that these impairments are happening despite the Dow being at almost 27,000, right? And so it's, I think a lot of times there's a thought that, well, impairments only happen, during the Great Recession, but what we find is that whether it's Kraft Heinz or GE or some other companies that we're working with, tech companies, again, where you would think that in this environment would be doing really well, but their impairments occur. And given sort of how the testing methodology is organized, that you have certain business lines, certain reporting units that may be impaired despite a really good economy, despite the Dow being at 27,000.
Mm-hmm. PJ, could you tell us a little bit more about how one does that testing to decide that an impairment is warranted? Like, what goes into reaching that decision?
So I'd say first there's some initial indicators that are helpful to look at, and one of the first things that I look at is to compare or do a ratio of carrying value to EBITDA. Mm-hmm. And so very quickly you can analyze what's the likelihood of impairment here, whether it's for a business or a reporting unit. And as an example, let's say the carrying value to EBITDA is 7 times, but the market is at 12 times. You've got some cushion there, right? Yeah. On the other hand, if your carrying value to EBITDA is 10 and the market is at 10 or 11 or 9, you might say, there may be a higher risk of impairment in those situations. So to me, that's sort of the first indicator that I go to. Of course, from there, what we do is actually go through the calculations of doing an impairment test. And today, those methods are pretty straightforward. Mm-hmm. In the past, impairment testing was maybe a little bit more involved, more convoluted. Today, step one is just what's the fair value of the business in comparison to the carrying value. Mm-hmm. To the extent that the fair value is less than the carrying value, the impairment amount is the difference. So it's really straightforward. And again, in the past, I think it used to be a little bit more involved in coming up with that impairment amount.
Okay. So, PJ, what are some of the analysis that somebody actually could do? You've mentioned it a little already, but tell us a little more, maybe walk through a hypothetical example of some big impairment or some warning signs that people would have.
Yeah, I think with that, Matt, oftentimes there are discussions that start, whether it's on an earnings call, in a press release about challenges that companies are having in a certain business or maybe in their business as a whole. So I'd say that you look for those early indicators, mm-hmm. And try to understand, well, what does that mean in terms of impairment? Now, in situations where there are sort of those early discussions that happen, oftentimes the actual goodwill impairment conclusion is sort of a non-issue. But we've also seen in certain situations where maybe there isn't that initial or early indication that there may be an impairment issue, where there will be a material impact on a company's stock price. And so I think when you look at impairments, they're really an indicator of risk, in my opinion. Oftentimes, we've seen this with different companies. Certain companies do a lot of impairment, and it seems like annually they're impairing assets, and it's probably an indication of the management team and the deals that they're doing and things of that sort. So I don't know if that answers your question, but I think there are, Goodwill impairments do provide good information, oftentimes early indication of whether a business may be impaired.
It does seem to me that in a lot of impairments, I tend to look at them once the impairment news is dropped. And then if you look at, say, revenue or operating information, in hindsight, it stares out at you and you're like, why didn't we think of this? Who couldn't have seen this coming? I guess my question is, how could one maybe a bit more thoughtfully try and see that coming before you're sitting around saying, why didn't we see it coming?
Yeah, and I think that is difficult, right? Because again, as I said earlier, intangibles and goodwill are inherently forward-looking, mm-hmm. and so as a result of that, I think there's a level of optimism that goes into, well, yeah, numbers are down today, but they will be better in the future, and so what we've seen is oftentimes the realization that things aren't getting better.
Sure.
And that's when the impairments occur.
So,
go ahead, Pranav.
So one of the things that we like to do as sort of a practice is once the acquisition has been announced and then accounted for through the purchase price allocation, it's a little bit of a labor-intensive thing, but computers have gotten a lot better at it and people have gotten a lot better at it as well. There may be a case where if the acquisition is large enough that the company discloses the performance of the subsidiary or the unit explicitly. Mm-hmm. And a number of companies have done that. And then what you can do is you can look inside the segment disclosure perhaps, and you may actually see that. So you connect sort of sections of this reporting document to one another. So the 10K will have the purchase price allocation, that business combination. 6 months later, you'll see perhaps that unit listed with their revenue and their operating profit. Now you can track that until the company stops disclosing it. Yeah. So, you can, if you avail yourself of the information, there is the opportunity. It's not always guaranteed, but there's the opportunity to perhaps take the analysis to the next level.
And Pranav, I would say that for us, doing valuations, we get to see that every day. Sure. And so we work on the initial transaction where the values are set up, and then we work with the company 6 months in, a year in, 2 years in, and to see how their view changes. And it's you can almost graph it to see that's sort of the, that's the, whether they're optimistic or pessimistic on whether there's impairments or not. But it's and it's a fairly regular, pattern.
It's a practice.
Yeah, exactly.
Yeah.
So PJ, tell us a little bit more about the procedures one would walk through to look at financial performance generally and see whether or not an impairment might be in the future for a company with a lot of goodwill on its balance sheet. Like what's the thought process to walk it through it?
Yeah, I think, Matt, the first thing that I look at is a ratio of carrying value to EBITDA, mm-hmm. And then comparing that to the market. And so, if you've got a company whose carrying value to EBITDA ratio, let's say, is 7 times, but the market is 12 times, you know that you've got some cushion there and the likelihood of impairment is low. Mm-hmm. On the other hand, if the carrying value to EBITDA ratio is 10 and the market is 10, you don't have cushion, and so the likelihood of impairment is a lot greater. So step one, that's what I would do. And as I mentioned earlier, this is inherently a forward-looking exercise, and so to the extent that you can get analyst estimates about future growth and EBITDA and things of that sort, you can do that same calculation on a forward-looking basis. Mm-hmm. That's also really helpful. And then from there, it's really going through and thinking about both the qualitative and quantitative items relating to the outlook for the business, trying to understand where the business is going, what the growth looks like, and trying to assess if the value is greater or less than the carrying value of the company.
Sure. And Pranav, what do you recommend? Because Calcbench has a lot of access to much more data. what are some of the analytical tricks that you guys have up your sleeve?
So we talked a little bit earlier about tracking the purchase price allocation and the details that exist in the business combinations disclosure. Once all of that has been cemented, you can then look at the unit that's been purchased by the company, and you might be lucky enough to get that reported as a separate operating segment.
Mm-hmm.
So you can then 6 months, maybe a year later, go to the segment disclosure, and you can do this en masse for you don't have to do it for one company. You can do it for 50 companies, and sort of you can map out what that business unit is doing in terms of its sales, perhaps its operating income, maybe even its its bottom line profitability if you're lucky enough.
Yeah.
And once you start to piece these, you take the puzzle and you're piecing all of these things together, you get a better idea as to whether or not there's a likelihood of impairment, assuming that the company reports all of these things to you, and and you can get a hold of it.
But if it does, that's a lot of data that can then help with some of the more qualitative, subjective analysis that PJ is talking about, and then you can get into your comfort zone about, is impairment likely or not? Am I stringing that together the right way?
It's along those lines, right?
I think so. I mean, I think one of the interesting things for us, being sort of on the inside, working with companies through both doing the deal and testing for impairment, is to see sort of their comfort level and management's comfort level with the likelihood of impairment. And quite frankly, what we regularly see is at the time of the deal, everyone's excited, they won, right? They did the deal. And then you get about 6 months in, and all of a sudden it's like, what do we have here? And then they go through a time period over the next year and a half, 2 years of integrating the business and getting, but it's sort of you could almost use that pattern for every transaction, every company we work with. I'm amazed, though, at the discipline that it provides to management. And I think that's one of the items that, I mean, you think about this from a user perspective and sort of what it indicates in terms of risk, but I think even from a management perspective, it provides a lot of discipline, right? You're thinking through not only, the excitement of did we win, but the discipline that goes involved with integrating the target into your company. And how does it fit in? What are the best elements of it? What do we need to work on? And then what are we going to do the next time we do a deal?
Sure.
So I find it, just from that standpoint, to be a really interesting process.
That's a great point. And I mean, to the extent that the analytics provides a window into that, one of the things that I would, we're seeing more and more of this is the C-suite is starting to, they're doing a lot of what we call benchmarking, right? And so when you think of benchmarking as sort of a profitability exercise. How profitable are our units versus a competitor or something? Or are we at risk if a supplier sort of changes their business model, those kinds of things. What you could also see is the ability of someone to not only track their acquisitions, but to track the industry's acquisitions.
Yeah.
That could be a data exercise that then informs future decisions.
Well, and we definitely see that. I mean, when you think, you talked earlier about the PPA database, and doing some analytics on that is extremely interesting, not only to us, but to our clients. As they think about doing deals, what are the composition of those deals, and
Sure.
What are others acquiring? It's not only about multiples, it's about composition, I think.
Yeah. So last question, just each of you give us some closing thoughts about the importance of getting these sort of analyses right, because it does seem that intangible assets and goodwill are only going to become more important to the balance sheet and the overall value of the company, like from here forward forever. So what do you have to say about the art and the discipline of understanding what goodwill is, where it comes from, what it should be?
Well, I think from my perspective, there's always an alignment that's sort of interesting to understand. So, you hear about the transaction, you hear why companies are doing the acquisition, and then you look at the business combination information and does it align? I think that's an important part of it. And I think also as you think about the different types of assets that are being acquired, but what does that mean for the business, right? And I think Warren Buffett had this line that said that intangibles or goodwill are the gift that keep on giving. And in many ways that's true, right? When you think about some of the brand names or the technology, they protect your margins and they continue to help you grow revenues and profits and things of that sort. So I think as you look at that information and you look at that data, you can really start to better understand what's acquired and what that means for the future of the business. And then finally, what I would say is it's also an indicator of management's ability. And so when you see a company that takes a lot of impairments, they're spending a lot of money. The numbers that you talked about earlier were sort of incredible in terms of M&A activity, and so then you start to say, well, is this management team good with doing deals, or are they wasting shareholder money? So to me, it's an important indicator of risk. It's an important indicator of management's ability to spend shareholder money.
And Pranav, any other closing thoughts from you?
We've touched on a lot of stuff today, but there's one of the things that I keep coming back to again and again. When you talk about management, you're talking about human beings in the seat making decisions, and so fear is an incredible motivator, right? When you see someone in your universe going out and doing something, you're worried that they're going to eat your lunch tomorrow, and so how do you compete in this environment, right? And so one of the ways to compete is by making acquisitions. Sometimes, there are a lot of people that when you apply the discipline, you say, I need to make that acquisition, but I need to make it I need to get the right technology, I need to get the right price, all of these things, and they all matter. But you're looking at balance sheets today that are flush with cash, right? And so cash today is a pretty low yielding asset. So, maybe you take a chance because you see your competitor doing something. And I think that's part of human nature that factors into this too. You can't necessarily get that from a financial statement, but they're pieces. So, you look here at the average cash balance, in the S&P 500, and you're talking about, well over $3 billion in cash per firm. And the big firms have a lot more of it. So, I don't think this is the acquisitive nature of America is not going to change. Big companies are going to be buying smaller companies for their technology for well into the future, which is good news for people like us because, it keeps us busy. Yeah.
All right. Well, guys, that's all the time we have today. But Pranav Ghai and PJ Patel, you gave us plenty to think about. Thank you very much. Again, everybody, that was Pranav Ghai of Calcbench and PJ Patel of Valuation Research Corporation. They joined me today to talk about goodwill on the corporate balance sheet, where it comes from, how you calculate it, how you might assess potential impairments, and how all of that works into studying M&A deals to see if they are living up to their expectations. For more information, you can visit Calcbench at calcbench.com, and you can visit Valuation Research Corporation at valuationresearch.com. That's all for this broadcast today. I'm Matt Kelly. Thank you for joining us, and I hope you have a good day.